Joining me now is Niku Hirachi, who is Managing Director of K1 Fund, which describes itself as an investment club investing in hedge funds. Mr. Hirachi, thank you very much for joining us today. Let's take a look at where you make money. You charge a 5% front load, 3% annually, and a 20% performance fee. None of this is unusual for a fund, of course, for a hedge fund. Presumably you're also paying fees to hedge funds. The point is you can outperform long-only funds when markets are volatile. Volatility, though, has been dropping off since a bit of a spike of that correction at the end of February. Do you think that's going to change?
Well, as you said, I mean, the volatility is a big question, and we've only seen volatility, slowing down or going lower for the past few weeks. And besides that, if you looked at 2006 and in the beginning of 2007, volatility has indeed been high. We think that volatility will increase further, but when it comes back to our fund, I mean, we are well-diversified fund of hedge funds, and we have had a volatility below 5% for the past 5 years. So volatility in the equity markets doesn't really affect us that much.
Right. On the other hand, of course, your returns, though over the last year, while perfectly respectable, haven't really competed that well with things like long-only funds. The K1 Global rose 17% last year. It's up 2.5% this year. These are your figures. The MSCI World Index rose 18% last year and is up 6% this year. So how are you going to turn things around, or are you simply just going to wait?
Well, I mean, it's been great equity markets, no doubt about that. If you had invested just in Asia or in China equities, you've probably even generated a lot more. But we are happy, and we look very much at risk-return numbers. For us, it's just not a question of generating high return, but we very much indeed look at low volatility. For us, it's risk-return, and our motto is consistent performance with low volatility. So we are not so much looking for really turning it around and trying to achieve the 30–40% range, because we know we would have to step up volatility, and we wouldn't appreciate that. And we started operations 11 years ago, and I think that our investors very much appreciate the risk-return numbers that we've been able to generate for them.
Right, I think, what did you gain over 11 years? 750%, something like that, I believe,
exactly, yes. That sounds amazing, but 11 years is also a long period of time.
It is. There's been some volatility along those 11 years as well. Well, now, you use a semi-automated asset allocation strategy. Basically, there are 3 primary criteria that have to be met, another 3 secondary criteria. No doubt there are others as well. Where are your programs and your managers directing the money right now? What kind of investments are you making?
Well, as you said, we have a semi-automated asset allocation system based on stochastic parameters. I would say that our criteria are simple, each criteria to understand, but however, when combined, very compact. Now, the most important criteria is that all underlying funds has to have at least 80% of profitable months. And then we have the second most difficult criteria for the underlying funds to be in line with is that the average or the maximum loss can only be 2.5 times the average monthly gain. So basically, if you take the entire hedge fund universe, and you see there's around, I would say, 7,000 to 8,000 hedge funds today, there are only 150 to 200 funds or hedge funds that are in line with our criteria. So, after we've narrowed it down so much, we still make sure that only maximum 25% is in each strategy, such as long, short, global macro, and then maximum 5% to each fund. So, taking all these criteria into consideration, that's how we actually diversify the portfolio.
Where is the money going? Would you say is more equities versus commodities, more long versus short, or what?
No, I would say that our main parts are fixed income arbitrage, distressed securities, and we have lowered our exposure to long-short equity this year, simply because we've seen, the last few weeks we've seen volatility going down, but we do expect that the equity markets will take a hit. And as we've seen in the past, the most long-short equity managers are more exposed to the long stocks, and so we have allocated more to long-short market neutral.
Okay, now the company's you've got a regional Asian HQ here in Hong Kong. You've got a Tokyo office opening as well. There's a lot of money around. You want to manage it. What are your targets?
Well, we have been, we've been working a lot, and we came to Hong Kong 1 year ago, and looked at the markets and could see what the potentials were. Now we have been very blessed with our strategical move of opening up an office in Hong Kong. We are, of course, only targeting professional and institutional clients. So far, it's going good. But Japan, the second largest economy, we see them being very professional and on their investment approaches. So we do think that within 2007 we'll be hitting the 1 billion target.
Okay, Niku, thank you very much for joining us today. Niku Hirachi at K1 Group in Tokyo there.